Hello and welcome to this Magellan Infrastructure Update. My name is Mark Jordan from Magellan Investment Partners. Today I'm joined by Ben McVicar, Co-Head of Infrastructure and Portfolio Manager. Welcome, Ben.
Thanks for having me.
To start with, perhaps you could provide an update on what happened in the past quarter and what were your key takeaways?
Yeah, so when you think about the last quarter, it was a pretty good quarter for the strategy, for infrastructure more broadly, and obviously it was the backdrop was pretty strong conditions in general. That's not to say there wasn't a lot of uncertainty out there in terms of the broader markets. What was kind of interesting for us is we always talk about the different sides of the portfolio. We've really got the infrastructure, the toll roads, airports, that part of the portfolio, and then the utilities. I think electric networks, gas networks, those businesses. What we really saw during the period was a bit of a shift in that, where we saw particularly the utilities, but particularly the North American utilities performing very strongly in that condition. And what was kind of interesting within that is those companies that did quite well were businesses that had sort of specific factors, whether they had some positive developments or removal of risks that did particularly well during that period. A couple of examples of that, just to put some color on it. We had one company, Sempra, who are a US-based utility. They've got operations both in California as well as Texas. They've also got an energy infrastructure platform as well, primarily LNG type operations. During that period, they had an important development where they sold down a major stake in that energy infrastructure platform, the SIP business. That was obviously good. The price we thought was reasonable, but what was really good about it was it unlocks the balance sheet a little bit more. This is a business who needs abundant capital to fund what is a really healthy growth pipeline in their particularly Texas operations. And so that really saw them do well off the back of it. We had another company, Xcel Energy, who are a Midwest-based utilities business. The thing that happened there is, this is a high quality business from our perspective. It's got healthy growth. It had a fire in its service territory in Colorado a few years ago. And you saw the sort of resolution of the litigation off the back of that wildfire, where a settlement was reached without the admission of guilt. That really allowed them to move past that potential. We didn't think it was likely to be a significant risk for them, but it was a contingent risk. So it's nice to see that go away. And the actual settlement value is immaterial to the overall investment case. Another example yet again is a company, Eversource Energy. Again, you can see the theme here. They're all US-based utilities. This one's a Northeast utility. It had a couple of things move in the right direction for it. One of the most important is they've got about 30% of their business in Connecticut. And you've had what you describe as fairly acrimonious relationship between the regulator there, or particularly the chairperson of the regulator, and the company in recent years. And you actually saw towards the end of the quarter, the chair resign their post, which that now opens up the possibility of bringing in a probably more harmonious functional relationship between the regulator and the utility in that jurisdiction, and unlocks their ability to actually deploy more capital and grow. They also have call it a legacy now offshore wind project, and they've been moving as well to having a bit of a conflict with the US government on that, where, as we know, the US government's moved away from things like offshore wind. And you've seen that going in a more positive direction with recent court rulings. So all of that led to decent performance for that business. On the other side of the ledger, what we really saw is yields, particularly in Europe, UK, impacted some of the longer duration, more defensive assets in that market. A key example of that would be UK water companies. What you'll find with those companies, for better or worse, they have a bit of a knee-jerk reaction to bond prices, bond yields going up, and that impacted their share price during the period. No fundamental impact from our perspective.
Fantastic. You just mentioned water utilities then, and the UK water sector is a significant part of the portfolio. How are you seeing conditions in the UK?
Yeah, so the UK, the economic, fiscal, political backdrop, it's tough at the moment. Obviously, economic growth has been harder to come by in recent years. You had a fiscal position of the government that's been challenged, not helped at all by the fact you've had enormous amounts of political instability, as you've seen in a lot of countries at the moment. And as it stands today, you've got a situation where the fiscal position is continuing to exacerbate the debt load. You're seeing sort of national debt continuing to inch upwards at the moment. You're seeing, as a result of that, bond yields continuing to move up. And obviously, at the moment, the political outlook has continued to be impacted by the fact that the sitting Prime Minister has incredibly poor approval ratings at the moment, which is only exacerbating the problem and causing less confidence from the bond market that you're going to see a resolution in the immediate future to these problems. Now, as you said, we have a decent holding in the UK market. We continue to really like the assets in that market. I mean, the UK might have these problems at the moment, but we still see enormous opportunity. When we look at some of these UK utilities in particular, so we've got, just to cover out the exposure, we've got some electric utility exposure through company National Grid, as well as a couple of water companies, water utilities in that market. From our perspective, those companies don't bear an enormous amount of risk due to the macroeconomic backdrop. What you tend to find for these businesses is if interest rates go up, they have a regulatory structure that allows them to broadly pass that through. Likewise with inflation. If anything, inflation is probably good for them. But what you do find is in the short term, there's this sentiment issue and there's this relative bond yield trade that goes on. So if anything, we've been looking at that as an opportunity to lean into some of those opportunities.
Global listed infrastructure continues to provide strong, reliable returns. Where are you seeing the opportunities currently, both in infrastructure and also in utilities?
Yeah, well, there's lots of opportunities that we see in terms of the structural growth opportunities that sort of sit out there in the utilities and infrastructure world. Some really simple ones, because we've been talking about utilities today. If you think about some of the thematics that have been playing out in recent years, one is that we've had a gear shift in terms of power consumption trends that seem to be now continuing on globally, but particularly in the United States. What we have seen is that the penetration of data centers into the market has really led to increasing loads on the electric grid. So that creates opportunity, but it's not just that piece. You've also seen things like electrification continuing on as a trend. We're seeing electric vehicles continuing to grow as penetration, and that adds more need for more capital and investment in the electric grid. On the other side, what we think is interesting is renewable energy. We've been talking about this for a while. The theme in renewable energy remains that, and it's highly correlated to what I just talked about before, is that you continue to see a very strong need to fill capacity into the market. And what's kind of interesting is whilst you might not be seeing the same degree of political support, particularly in the United States at the moment for the energy type, notwithstanding that, it's a difficult market to actually find other energy at the moment. So nuclear takes a long time to build. Coal, it's not something that's on most people's development agenda at the moment. And gas-fired, whilst it's an abundant and relatively clean fuel source, what you're finding is there are supply chain bottlenecks that are slowing down the development of that. So here you've got renewable energy, things like solar, which are available, quick to build, and now very cost-effective. So we continue to see an opportunity to deploy into that. As a reminder, we don't invest in the merchant power stations. Where we do that, we like to do it through a utility who's got a regulated set rate of return, so that you've got the confidence as to how the return's likely to develop over time. And maybe a final one that's kind of interesting to us, which now takes you to the other side of the picture for us, is in motorways in the US. Whilst not a sort of a national level initiative, we're seeing individual states starting to show more interest in building out what would be a sort of an equivalent motorway structure there, where it's not an entire toll road, but it's tolled lanes on the motorway. And we're seeing that after a number of years of having some success there in states like Texas and Virginia, you're now seeing other states like Georgia and Tennessee starting to show some interest there. And these are multi-billion projects that have significant investment opportunity, and if you're done right. And the market leaders in this space in the US for these types of roads, two portfolio companies, Ferrovial and Transurban.
What should investors expect going forward, and how have you positioned the portfolio?
Yeah, I think when we step back and we look at infrastructure today, what we see is on average, a set of valuations that look reasonable to us. It doesn't look hot, and it doesn't look excessively cheap either. We don't expect high quality infrastructure companies to trade at huge discounts as a sector. You don't generally, I think, as an investor, expect to buy high quality assets in which the type we invest and we'll focus on at enormous discounts structurally. Buying them at fair value is reasonable in our view. what we really think investors can expect out of that is a CPI plus 5 type outcome. I break out inflation because these are pretty inflation protected assets. So whilst they don't have a share price response, you do see they've got a very good protection at the asset level, the cash flows that they generate, where they get to pass through inflation. So there's good protection there. And then we think the 5% return seems achievable in current market conditions. So on average, when we look at the portfolio, we think it looks reasonable. We continue to find pockets of significant undervaluation, and we've structured the portfolio so we can take advantage of those opportunities that we see in current markets. But overall, we feel confident about the outlook for the portfolio.
Thanks, Ben.
Thank you.
And thank you for watching. If you'd like more information on Magellan's infrastructure funds, please contact Magellan Investment Partners. As always, feel free to share this video with clients or colleagues. Thank you.